Hey everyone, in today's video, we're going to be talking about 4 top REITs to add to your watch list or your portfolio. Throughout this video, we're going to go over their stock prices, their valuations, their dividends. We're going to look at some of their investor relations information on each of these companies. We're going to look at REITs from some different sectors here as well. So this should be a pretty interesting video. I'll put timestamps on the bottom if you guys want to jump in between names if you're not interested in a particular REIT. Before getting into this one, a couple things I just want to say. If you like this type of content, be sure to subscribe to the channel. Give this video a big thumbs up for the YouTube algorithm. It really helps my channel a lot. Still a really small channel, so I'd really appreciate it. And then secondly, I have a bit of a cough. So throughout the video, rather, if you hear a cough or two, apologies in advance, but it shouldn't be too bad. Okay, jumping into the first one here, Realty Income Corp. So if you're invested in the REIT space for an extended period of time, you've probably heard of this company. It's probably the most famous REIT in the world. They're known as the monthly income paying company. They've paid a monthly income for 600, 700 straight months, something like that. And they tend to increase their dividend annually, if not every quarter. So it's a great business. It's a retail REIT. Just looking at their stock performance before diving a bit deeper, you can see that they really performed well over a long period of time, from 2018 at about $50 a share all the way to high 70s, maybe even touching 80 briefly right before the pandemic. Obviously, after the pandemic, it nosedived as everything tied to retail did, and it's slowly been climbing its way back up. We saw it go down with interest rates coming up, which is very natural for real estate exposed assets and stocks. And now it's kind of stabilizing around $62 a share. This company at these valuations is paying about a 5% dividend annually. And if I look just over the last 1 year, it is down 15% because of those interest rate hikes that we saw back half of last year. So overall, this is a $41 billion company, not trading at the low end of its range, but also not the high end. If we look a bit more about this business, just summarizing some of their comments, they've had almost 15% compounded annual returns between the stock price and the dividend payouts, and they've had an annual dividend growth rate of 4.4% over the last 20 odd years, or 30 odd years. So they have a very good track record on creating shareholder value. They are a dividend aristocrat. They are a top 5 global REIT, and they actually plan on continuing to grow their presence. They see a lot of opportunities and benefits of being large and having scale, which we'll get to in a couple minutes as well. I really like, and it should go without saying for these types of companies, but they really focus on the dividend, increasing the dividend, and their entire mission essentially of the company is to treat the dividend almost like as a religious aspect of their mission, to make sure they're paying those monthly dividends and they continue to increase them with time. So I just really like when that's such a core part of their strategy. It really just speaks to how shareholder friendly the business is. Now, going into their assets, you can kind of see here, you are buying in the bottom right hand corner, you are buying a retail REIT. No doubt about it. 82% of revenue specifically from retail. Industrial, some nice diversification, 10-15%. Gaming is the Encore in Boston. They bought one building there, and then other 1.9%. So pretty much you're buying over 80% retail exposure. When you look at their top 20 clients, they have very good tenants. Dollar General, Walmart, Walgreens, 7-Eleven, BJ's, LA Fitness, Home Depot, Kroger. So just by kind of saying some of those tenants, you get a good sense of the types of real estate that they own, where they're placed, stuff like that. Usually very good locations, traffic centers, stuff like that. I guess the one that you may not want to see here is AMC Theaters is probably a tough tenant with respects to growth prospects or just challenges potentially with future bankruptcy, depending on how that space develops over the next number of years. But generally, they have some very defensive, great tenants that you'd want to have that aren't really going anywhere in the near future. From a industry diversification standpoint, grocery stores, convenience stores, and dollar stores collectively are about a quarter of the total rent of the business. And then as you keep going down, it's some other good exposure, whether that's drugstores at 6%, home improvement, quick service restaurants another 6%. So they're pretty well diversified in terms of where they're getting their revenue from. And then from a geographical sense, I really like their geographical diversification. You see the top markets here. I also love that 10% here is from the UK, so it's not just a US play, but also from going state by state. I love this chart here where it shows how diversified they are. They're in every state. They're also in Alaska up there, and not one state makes up more than 10% of the overall business. Texas here is the top one at 10.4%. Then you got California at 5, Florida down here at 5. Probably, what is this? I don't know my U.S. Geography too well, obviously, but Massachusetts at 4, etc. New York, that's what I was looking for, at 3% up there. So they're very well diversified across the entire United States with the amount of properties, the amount of rent they have. Then they also play overseas here, so 10% in the UK. And then in Spain, they have about 1%. They just acquired a small portfolio of assets in Italy as well. So I'm hoping that that continues to be a growth strategy for them so that we get more and more geographical diversification along with diversification of tenants. Looking here, very similar chart than what we were just going through, so I won't belabor the points here. But they're really focused on, within their retail exposure, making it consumer-centric type exposure, grocery chains, pharmacies, medical centers, stuff like that. So they're all over making their revenue base as defensive as possible and as less volatile as can be. So overall on this company, it trades at about a 15 to 16 times funds from operation multiple, 5% dividend payout. Great business overall. So this is one that I actually recently started a position in. The company's, I wouldn't say it's cheap at 15 times given, interest rates where they are and maybe needing to get higher interest rates on fixed mortgages and credit as it comes up. So maybe some downside valuation there, but I like how it's all triple net lease. I like the quality. I like the diversification. So this is when I started a little position in recently, and I really like the name for the long run. Going into stock number 2 in terms of top US REITs that I like, it is WP Carey. So WP Carey is a diversified REIT across many different asset classes. Looking at this one over the last 5 years, up about 15%. They pay a slightly higher dividend than Realty Income. I think they're closer to 6% today. As we look at their assets, very similar chart that you see to Realty Income. The only exception is they really haven't had a little pop as of late. They had the same pandemic drop, the same increase back, but we really haven't seen, we've seen a lot of weaknesses, I guess what I'm trying to say, over the last, 2-3 months, down almost 15% there. Company is a lot smaller, but still large, almost $16 billion versus $40 billion on Realty Income. As we look at their geographical diversification, 2/3 of this business is in the United States. 1/3 of it's in Europe. I think 1 or 2% are other, which is like Mexico, Canada. So I really like this breakdown of revenues from a geographical perspective. This is probably what I would say is ideal, to be honest. Just over half in the US, you have a nice chunk in Europe, and then a couple percent in miscellaneous countries as well. So I really like their geographical diversification. In terms of property type, 26% industrial, which is great assets to hold, 24% warehouse, office is 17%, so that's pretty dicey. Retail 17%, some would say they don't want too much retail exposure. Self-storage is great, or it's performed great as an asset class recently. And then other, I think that's more like not parking lots, but different kind of unique assets that they have for some of their tenants to do business in. So pretty well diversified across the board. Some exposure you may not want depending on, your risk appetite, and maybe that 20% office exposure is why the company's trading at a lower funds from operation multiple and paying a higher dividend. So something to keep in mind when debating, which one of these stocks you may be more interested in. In terms of their top tenants, you can kind of get a sense of the difference in these businesses from Realty Income and WP Carey. Their number one tenant is U-Haul. So you kind of get a sense that, more storage space, more unique real estate where they can park all the trucks, stuff like that. Not so much your corner store down the road. They also have Marriott, who net leases hotel properties. So lots of unique types of businesses, advanced auto parts, so distribution facilities. They even have, oh, this is interesting, do-it-yourself retail properties in Poland is 2% of their rent. So a lot more diversified, also a lot more all over the place in general in terms of the type of assets you're holding and where you're getting your rent from. Their performance from Q4, just from a tenant and industry standpoint. So just looking here, 21% is retail, 15% is other, 8% is consumer services. So think like hairdressers, probably gyms and stuff like that too. Beverage and food, so restaurants is also 8%. Hotel and leisure is only 4%, so that's probably the Marriott leases they got going on. And then everything else is pretty small, 2-3% across the board. Containers, packaging, and glass is 3%. That one's kind of interesting. I don't know if they own a port somewhere or something random like that. But you get a sense it's a very diversified business in terms of types of real estate they own, let's call it. And then something that's important, especially with the interest rate environment, is debt maturity schedule. So what's good is they don't have very much debt that is coming up this year, but 2024 and 2025 they have over $1 billion. They have like 1.3 billion, and then they have 1.5 billion, so like 2.8 billion in debt in the next 2 years after this one. That is a bit concerning if they have to refinance this at higher rates, especially with like some office exposure. Not sure what kind of rates they're going to get. Especially interest rates today on this are pretty low, and collectively this is almost 40% of their total debt. So a bit concerning there. I don't think it's anything they're not going to be able to manage, and that they at least have a year or have had over a year to plan for this. So I'm sure they're on it, but probably a bit of a profit headwind looking forward. Okay, looking forward into stock number 3. Use that twice there. Okay, Ventas. Ventas is a healthcare REIT in the U.S., similar size to WP Carey, about $18 billion. This one pays a dividend, I think around 4%, maybe slightly under. If we look at its performance over the last 5 years, you're seeing a very common trend here where these stocks were at all-time highs, low interest rates, great economy, and then COVID happened, and they slowly have come back up and then dipped a bit more with interest rates going up. If we look at where it is on the year range, we're at $45. Year low is 35, year high 60. So this one's a bit more volatile, a bit of a wider window there, but it's trading, on the lower end of the 52-week range, but not too close to the bottom, about 30% higher than the bottom of the range. Looking at the stock here, this is kind of just showing where they get their revenues from. So lots of medical office exposure, lots of triple net leases with different skilled nursing, senior housing, stuff like that. Just exposure across the medical and healthcare space in the U.S. So think like life sciences, research and innovation centers at universities. They own lots of those, but much more unique and niche REIT for sure you got here. And kind of call it out here, within the total world of U.S. publicly traded REITs, healthcare is about 10% of that, and Ventas is one of the largest healthcare REITs within the top 20 largest U.S. public REITs that are traded. So this is a big company, 17th largest REIT. They've been growing their FFO about 5% a year, which is pretty standard, and they have a very relatively low payout ratio, which means that they're focused on more acquisitions and growth. If we just look at some of their strategies here, they're looking to operate some scale across their properties and technology and what they're rolling out. And I feel like within healthcare, when you're a healthcare landlord, you kind of not overstep, but you step over just being like a triple net lease business, and you really do tie in technology and other benefits for your customers. It's a really unique space to play in. It has its cons on that in terms of it not being as hands-off and it being a bit more to it. But it also has its pros in terms of the dollar per square foot and stuff like that you can charge your tenants. And then lastly, just looking at the 2023 outlook, in 2022, funds from operation were $3, and you should think of this as like profit per share. And then for 2023, midpoint guidance is $3 again. So they're not going to hit that 5% growth they've done historically on funds from operation, probably because of the interest rate headwinds. But if I look at $3, that means this stock is trading literally right at 15 times earnings on the year. So, about in line with Realty Income. So it's really up to you. Would you prefer a state-of-the-art retail REIT or maybe a bit of a more complicated healthcare REIT that owns buildings and universities, has some office exposure, but you can argue it's good office exposure given its medical buildings and stuff like that. So lots of puts and calls on this one. You get a bit of a lower dividend at about 3.9% because they only pay a 62% payout ratio, looking at reinvesting the rest of those proceeds in acquisitions and growing the business internally. So it really depends what kind of asset you want. Going into the fourth and final stock, this is a residential stock that I've been looking a lot at lately. This stock, I believe, I was checking, okay, this stock pays a dividend of 3.8%. And let me just double check Ventas dividend yield. Okay, so it's right at 4%. I wasn't too far off. Anyway, AvalonBay Communities, like we just looked at, 3.8% dividend, similar to the other stocks, trading at the lower end of the 52-week range, but not right at the bottom. And you're going to see probably a very similar chart here. What's interesting is they actually re-hit 52-week highs last year, so they've been on a bit more of a roller coaster than even the retail REITs. This company is a $25 billion market cap company, so one of the biggest REITs in the U.S. Looking at their business and where they own residential real estate, you can kind of see here some of their key areas. You got Boston here at 10,000 homes, New England, 10,000 homes, so really Northeast centric, I suppose. New Jersey, New York, so a lot in the Northeast up here. Then you got Florida where they have some exposure, 3,000 homes. And then Mid-Atlantic, so across California, it looks like they have 12,000. Mid-Atlantic, they have 15,000. Southern California, wow, almost 18,000. And then Pacific Northwest, Colorado, Texas, much smaller. But overall, about 82,000 units that they own. I think strategically, they have been trying to build their portfolio more in the middle of the country. So they have a ton of exposure on the Northeast side. They have a ton of exposure on the West side, but they're really trying to grow. First of all, Florida, it looks like they've been doing some acquisitions, but also in Texas and kind of middle America, for lack of a better term there. And they actually call it out in terms of revenue per growth projections for those areas. So right now, developing markets is what they call it, is 7%. By the end of 2023, they want it to be 10%, and they have an eventual target of 25%. So they want to become more of a national residential REIT, whereas right now they just play in California and on the East Coast, essentially. So that's really where their strategy is going. They're developing residential assets in Texas, Florida, all these other places. They're also disposing of assets in New York, in New Jersey, and buying assets in Texas and stuff like that. So personally, I tend not to love these strategies of that require a lot of M&A and selling assets here, buying assets here. I think a lot gets lost in the middle. And like there's so many other opportunities for me as a shareholder to get exposure to those states and properties in those states. If I wanted to, I could just buy another REIT and not have to deal with all the focus being moved towards those endeavors and those initiatives within one company. I'd rather them be focused on different forms of value creation. But that's just my 2 cents. I should have just went to this slide here, but in terms of the projection of where they're going to be in the future, they're going to be 40%, 43% West Coast, 36% East Coast, 21% expansion regions is what they're call it, rather, and they want to get this to 25%. Looking at their performance, so funds from operation, which is the only thing that matters, don't look at EPS on REITs, is $2.50 on the quarter, and let's see if I can find the full year here. $8, $9.67 on the year. So just under $10 of EPS. So we go back to their stock. They're trading at, 960, I think it was. So they're trading at 18 to 18.5 times earnings, and they're paying out a 4% dividend yield. So for a residential REIT that probably demands a higher premium than some of the other ones we talked, that's probably about fairly valued relative to those other names. And it's nice to see that they've actually been growing that. So I'm not sure if that's just rent increases have been outpacing the interest rate impact, and I'm not sure what their debt maturity looks like. So that's something to look at before investing in these types of stocks. But overall, I think probably fairly valued given everything else we saw. So I'll give my opinion on these names. I think all of these are great companies to begin doing research on, looking into. Personally, Realty Income was my favorite out of the group. They pay a great starting dividend at 5%, essentially right off the bat. They have great assets, triple net leases. They're growing their geographical exposure by buying assets in Europe, which I love. They're in all 52 states already. They're operating projects that are delivering value from having scale, and they're continuing to scale up. So this is just a great business, very proven business model, executional excellence over the last 20 years. So this is the one that I've invested in so far. When I look at the other two, WP Carey, I love their geographical exposure. I love their higher dividend, but they do have 20% office exposure in some markets that are having a lot of trouble with office. So because of that, and because this company is just so much more complex in how they operate, where they operate, the type of assets they hold, it's probably just one that I won't look into farther, just because it's not as straightforward and simple of an investment. And then Ventas, I don't like some of the assets or just some of the dynamics of healthcare real estate and some more complexities that come with it. When you lose a tenant, it's not as easy. It's not a million, or not a million, but not 500 Fortune 500 companies knocking on your door that are in retail to take that space. It's much more complicated to deal in this space. So just, I'm not an expert in healthcare REITs, so not one that I'm really interested in getting more exposure to, especially in the US. And then lastly, AvalonBay. This is one I'm going to continue to watch. I think if the value gets right, I may look into it a bit more to get a better sense of their debt maturity cycles. So out of the four, this was my second favorite after Realty, and probably the only other one I'd actually consider investing in close to the valuation that it's at, because I just love the defensiveness of residential real estate. We don't have enough houses and apartments in North America. So I think over time, these have a floor in terms of vacancy because of that, and a lot of opportunities in the markets they operate in. So thank you guys for watching through the whole video. If you did, please let me know in the comments. Not many people make it to the end, so I really appreciate it. Also, thanks for bearing with me through a couple of coughs throughout that. I'm trying to get over a bit of a sore throat here. If you like this type of content, please be sure to give this video a thumbs up like always. Would love it if you subscribe to the channel for future videos as well. And I'll see you guys in the next one.